Redcloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Redcloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Redcloud Financial Services. I'm Mark Bunting, the host of RCTV. Thank you very much for being with us today. We're taking your questions as always. If you have any, you can put them in the right-hand side of your screen in the comments section, and we'll get to as many as we can toward the end of the show. The topic of the show, as you likely know, is the art of investing in precious metals, physical precious metals. And the gentleman we have lined up to tell you all about this is uniquely experienced. He is encyclopedic when it comes to this topic. He and his family have been involved with physical precious metals for decades now, and he's going to tell you all about that. Let's bring in David McAlvany, the CEO of McAlvany Financial Group and McAlvany Precious Metals. David, thank you very much for joining us today. Great to see you.
Mark, wonderful to be with you.
Let's kick things off for those who may not be that familiar with McAlvany in terms of the history, which is really fascinating. Your parents started a bullion dealer back in 1972. And you can correct me if I'm wrong. I believe it was one of the, if not the only one at that point, one of the original full-on proper bullion dealers. And beyond that, your father, he was instrumental in getting private gold ownership in the United States made legal again after it was illegal for more than 40 years. So can you give us a little background, a little maybe a little flesh on the bone there in terms of that history?
Yeah, so my dad was a Wall Street guy, and he was at the time working for a small boutique firm, Betcher and Company in Denver, Colorado. They did a ton of municipal bond underwriting, and so the portfolios were particularly interest rate sensitive and inflation sensitive. There wasn't a great way to hedge against that, and so late 60s, early 70s, we had the guns and butter policies of the Johnson administration. We had real pressure building from a fiscal standpoint. And, then we have very little room to maneuver in terms of assets to hedge with. If you wanted to own gold stocks, you could do that. And the need was there for gold ownership. You could own rare coins, you could own, jewelry, things like that. But bullion ownership had been prohibited going back to 1933. During the Great Depression, they wanted to increase the money supply, and being tied to gold was a limiting factor. So they created a two-tier monetary system where we maintained our credibility with foreign creditors by having gold still deliverable, exchangeable, a part of the US dollar system. But domestically, they were inflating away our issues, creating more liquidity, pumping that into the banking system. So they made it illegal in 33, not legal again until January 1st, 1975. My dad worked with two other gentlemen here in the States, specifically channeling their efforts through Howard Sagermark. He did the lobbying effort directly with Senator Jesse Helms in North Carolina, and the legislation changed. January 1st, 1975, U.S. citizens could own gold again. We had kind of a first mover advantage in the bullion market because we started in 72, having found a tax loophole that allowed us to create a network of about 1,200 different Wall Street firms that we were providing metals to at the time on a wholesale basis.
So interesting. Now, David, personally for you, you didn't go directly into the family business. So you had other ideas. And at one point you were at Morgan Stanley when you started to get a realization that there was real value in owning physical gold. And I believe part of that was because of Barton Biggs, the famous strategist who had written a piece internally. Is that correct?
That's right. It was not meant for public distribution. And it was sort of the insider's way of saying, I think we need to pay attention. Something is shifting. So the story was told of a young derivatives trader who in the mid 80s had come on board, had all the pedigrees, the right schools, the right channels, and was on the derivatives desk there at Morgan Stanley. And everybody thought that he was crazy, particularly in 1987 through the summer months where he thought that the firm should be going short the market. He did that with his own money, with family money. And, as Barton Biggs told the story, this guy retires to Sun Valley in his early 30s. He goes on to say in this missive that Peter Palmetto, the gentleman in question, had started Sun Valley Gold, a hedge fund specifically focused on the mining sector. And we know Peter's crazy. And he ends the missive saying, unless we are. And it was this sort of way of saying, if you're interested, this is the place to go. And it really was a unique period of time. 2002, 2003, we've got gold trading just above $300 an ounce. And it was the beginning of a structural bull market, which has now moved, 10 times in price.
Right. Let's get to physical gold right now, which is near all bank buying in the past few years, and apparently it's makes up about a third of total physical buying of gold. But as you point out, central banks, this is not a new trend. Central banks around the financial crisis, during and after that, started loading up on physical gold, and you call it a stabilizer for central banks. So could you expand on that idea?
Yeah, the trend all through the 90s and up until 2009 was net liquidations of gold in favor of financial assets. The global financial crisis comes around, and 2009 was the first year where they were net positive in purchasing gold. And, from 2009 to 2016, you were talking 200-300 tons per year in central bank acquisitions. Then in 2016, it bumps up to closer to 500 tons a year. 2022 rolls around, Russia invades Ukraine, the US Treasury seizes $300 billion in Russian assets, and for the first time in history, sanctions a central bank. Central bank community recognizes this as a real change and is looking at their reserve management different from that point forward. So they've gone from 500 tons a year to now over 1,000 tons a year each year since 2022. And they're looking at diversifying away from US dollars. This has been a trend that's been in place since the year 2000. If you look at central bank reserves held in US dollars, it was as high as 71% starting the millennium. And now it's 59%, 58% in US dollars, with a greater proportion held in euros, a number of other currencies, and now close to 20% in gold on average. Some of your more established developed economies have 50, 60, 70% of their reserves in gold. And many of your emerging market economies, this is where you see a lot of the catch up being played. They've had low single digits and they're moving into the teens now, perhaps with an objective of getting north of 20%.
David, you've said you've also noticed, especially this year, people taking delivery of physical metals, such as high net worth individuals and family offices as well. So to your point about perhaps I don't want to put words in your mouth, but an erosion of trust in the US dollar that is ongoing. And also, would you say that part of that is also the fact that Washington with the new administration has really sort of unsettled the global order, to put it mildly. And that's part of the reason that people want to take physical delivery. Is that fair to say?
I think that's fair to say. I think there's other factors as well. If you think of the world today, it's anything but perfect. And yet you look at current market pricing and equities, and it looks like it's priced for perfection. So what we've seen amongst high net worth individuals and family offices is an awareness of Russia and Ukraine, Israel and Iran, India and Pakistan, the potential of conflict between Taiwan and China, and the disruptive nature that would have towards everything AI related and what has been sort of a primary growth trend. And so what we see, I mean, certainly you're exactly right. Tariffs and sort of the chaos that comes from that, fiscal sustainability, both on this side of the pond in Europe and in many places around the world. They're making an appraisal, and the appraisal is this: the world is not as perfect as the equity markets would imply by current pricing. Perhaps we should have something that represents a hedge in case the equity markets end up being wrong.
Now let's get to what you do and your team does at McAlvany Precious Metals. You've pointed out that the physical gold market is mostly unregulated, and there are instances of fraud, and investors have to be careful. So we know that Hedgeye Risk Management did their due diligence on McAlvany and then partnered with your firm. So that says a lot, because I know we both have high regard for Hedgeye Risk Management. So can you explain the services you offer, and also the relationships you have with the COMEX and NYMEX related depositories, whereby investors know what they're getting, they know their gold is there, and they can sleep at night?
Right. So we've been in the brokerage business since 1972. The vast majority of our clients prefer to take physical delivery of their gold. So you don't have any third parties involved. Once the metals are delivered, it's up to the client to have them safely and securely stored. We do, and since 1986, have been, we actually were the first company to put physical precious metals into IRAs, into retirement accounts. That's when the tax code changed in the US and allowed for that. All of those metals are stored at a COMEX, NYMEX depository, and they have to be held in trust until you're taking distributions in retirement. So we've expanded our offerings there. We also have sort of a fintech solution called Vaulted, which is sort of a low-cost way of accumulating gold in large format bars. We've partnered with the Royal Canadian Mint in Ottawa, and also with HSBC in London, to be able to provide the cheapest silver bars on the planet. That's through HSBC in London, and then RCM provides great kilo bars for us. The unique aspect of that particular offering is it allows you to accumulate very inexpensively in large format bars, best pricing in the market. And then if you choose to take distributions, because of the way we've structured the transactions, there is no taxable event if you want to come out of a kilo bar, out of a 1,000-ounce silver bar, and take delivery in a format that's easier to handle, 1-ounce coins or things of that nature. So no taxable implications there. So you've got a tax advantage in our program. Accumulate cheap, take delivery in any form you want. So those are our basic services in metals. When you are storing metals, it is important that you're working with a COMEX, NYMEX depository. These are groups that are under high scrutiny all the time. They have adequate insurance. They have amazing processes and protocols to maintain the security of their facilities. And I think anything outside of a COMEX, NYMEX depository, I would hang a question mark over. There certainly are other services and other service providers, but if you're looking for security and potentially liquidity, you want access to the biggest pool of capital possible. So again, it's one of the reasons why, like for silver, HSBC is great. It's the largest silver pool in the world. And so liquidity, either buying or selling, we can do it in any quantity. And so those are some considerations when you think of storage and sort of introducing a third party to provide that service to you. I think more often than not, it's not fraud that's an issue. It's just abuse within the industry, because there's no oversight like the SEC, NASD. How are things priced? Are they priced fairly? And that's where, getting very clear on what your costs of transaction are, that's really critical, because that's where, you'll find a wide difference from, a percentage point, 2 percentage points, up to 20, 30, 40, 50 percentage points. There are some crazy pricing in the market. And in that sense, it is very much a buyer beware market.
Back to the Royal Canadian Mint, David, I'm just wondering how that relationship came about, and did you see the Canadian Mint as one of your better fits because of the liquidity?
Yeah, liquidity is a part of it. We also like the fact that we don't have to deal with conflict gold. If you're dealing with gold that's coming out of the Democratic Republic of Congo and then being refined on a first round in United Arab Emirates, and then being shipped to Switzerland. You have no idea who was actually doing the work and how they were being compensated, if it was fair, if there's fair practices involved. What I love about the Royal Canadian Mint, as it applies to their gold bars, it's all produced in North America. It's all Canadian production. And we know what that looks like. There is no child labor. There are no abuses of that nature. And so we love the fact that our sourcing, if you want to call it ethically sourced gold, we love that. So that was very appealing in working with the Royal Canadian Mint. We also love the product that they produce. I love their 100-ounce silver bars. I love their kilo bars. They're one of the cleanest, highest quality products in the market.
Well, that's great to hear. Now, one of the concepts that McAlvany likes to espouse to its clients is the idea of compounding one's ounces. So could you explain what that looks like, and maybe use, I don't know, junk silver or some type of bar to maybe explain that for us?
Sure. Well, there are many ways to create wealth. What we look at with gold and silver is that this is a representation, a store of value, a store of wealth through time. The criticism that's been sort of laid against the metals is that they're a non-productive asset. So, classically, Warren Buffett has said, I don't want to own this stuff because it's not producing anything. Where's the dividend? Where's the growth? You're waiting for a move in the metal. That's what you've got. What we've done is we've taken differentials in pricing, whether that's premiums on particular products or ratios between different assets, gold, silver, platinum, palladium, and we've used those premiums and ratios to compound ounces. So I'll give you a personal example. Over the last 10 years, specific to the US silver market, bags of junk silver, when you can buy bags of junk silver, our currency prior to 1964, dimes, quarters, 50-cent pieces, 90% of the content was silver, 10% copper. If you can buy those bags of silver at or near spot, the premiums in high demand markets will get to 15, 20%. And that allows us to take the premium and roll it back into 1,000-ounce bars and own that many more ounces. Then we wait for the premiums on the bags to drop again, and it's just a rinse and repeat. We do it again and compound ounces. We've had 5 of those trades in the last 10 years. And so on an after-tax basis, you're looking about an increase in ounces of 65%. You're not factoring in taxes, almost 100% gain in silver ounces using the bag-to-bar trade. That's something that we do on a routine basis. And less frequent is the gold-silver ratio and what that opportunity opens up. But it's the same objective. It allows us to grow the number of ounces regardless of the price. So if you've allocated a certain amount of wealth to gold, it is not a dead asset. It is not, as Buffett has suggested, something that's not compounding. We can compound ounces. And if you look at gold and silver as an intergenerational asset, as a representation and a store of wealth, this is a way to continue to expand it over time.
You touched on the gold-silver ratio. Let's explore that a little bit more, and then move on to the Dow-gold ratio, the importance of them, and how you view them. So the gold-silver ratio a few months ago, when gold was at all-time highs, but silver hadn't really started to move yet, I believe it got to something like 107, but it was definitely around 100 for a while. And you pointed to only a few instances over time where that's happened. And usually when that happens, that's when eventually silver will start to move. So how can investors use that ratio to their advantage?
Frankly, it doesn't happen frequently enough for a trader to be interested. This is not something that happens in a week or a month, but this is where a partnership with a company like ours, where we're responsible for getting in touch and letting you know when there is an accretive trade, we'll let you know when it's happening. So at 100, as you said, at 107 to 1, silver relative to gold is very inexpensive. And the range is anywhere from that 100, 110 level down to about 30. Back in the Hunt Brother days, we did see it get as low as 15. I don't think that's a reasonable number. If you looked at a 100-year average, 150-year average, it's about 30 to 1. And since 1975 to the present, that average has been creeping higher, closer to 60. So you still have swings below the 60 level. They're just not as frequent. So 100 to 1 is a great time to be owning silver. And as you get closer to 50 to 1, certainly if you're into the 40s, you should be thinking about converting a good part of your silver into gold. And that is a way that you can also compound ounces. So we're just playing the volatility between the metals. And again, if somebody says, I want to have a hard asset portfolio, I want to have physical, tangible wealth in the form of metals, this is a way to be able to sort of grow regardless of the price. And it's, to me, it's a great way to sort of steward wealth intergenerationally.
And when you say the gold silver ratio was around 100, 107, 90, let's say, do you believe that no matter what, even though it may take some time, that ratio will always revert to the mean at some point?
Well, what you generally have is, as gold gets to a high level, investors are priced out. The retail investor, and this is a perfect case in point. We talk to clients every day, and they ask the question, at $3,500 gold, it's never been higher. Is it too high a price? And I can certainly construct a case for higher prices in gold. If you want to have that conversation, we can. But it is the highest price we've ever seen. And so you've got a lot of hesitation. What that translates into is people saying, what else should I be considering? So platinum, trading at a discount to gold, becomes an attractive opportunity. Silver, trading at a very high ratio, which would suggest a discount to its normal relationship to gold. Again, it's a better value. And so that's where money tends to flow. Now, the issue there is the white metals are so small. The markets are so small relative to gold. It doesn't take a lot of investor capital to move those markets dramatically. So you see very, very quick movement, very high volatility. It doesn't take long to go from 100 to 1 to 60. It doesn't take long to go from 60 to 30, and then the move's done and it's reverting back the other direction. So it really is, just a small investor footprint, typically in the West, that drives the silver price higher. And we've begun to see that. We had silver kind of stuck in the mud, $32, $33, $34 an ounce, and it looks to be just breaking out now. And so I think we will see a move towards the mean. I think we're in that process as we speak.
Right. The silver, as you know, got to very close to $40 an ounce yesterday before pulling back a little bit. Now, still with ratios, you like to cite the Dow gold ratio. It's currently around 13 to 1. This Dow Jones index to the price of gold. You point out, though, in 1929, during the crash, that got 1 to 1. And during the financial crisis, it got to around 6 to 1. So what's the importance of that ratio, and where do you see that going?
Well, I would encourage any of your listeners to go online and just type in Dow gold ratio long-term chart. Look at it, because what you have in that picture is an expression of market sentiment. When market sentiment is strong, specifically for equities, and risk-taking appetite is robust, there's really no reason to have a hedge asset. And so people are focused on growth. They're not focused on the insurance aspects of the metals. And you'll see the ratio get to higher levels. By 1929, we were at 18 to 1. By 1933, we were at 1 to 1. By 1966, we were at 28 to 1. By 1982, we were 1 to 1. By the year 2000, again, at the end of a long stretch of growth in equities, we were at 43 to 1. Global financial crisis got us as low as 6 to 1, rallied back to about 22, and we currently sit just above 13 to 1. We think this cycle ultimately finishes with not only strength in gold, but weakness in the metals, or weakness in equities. You get those two combined, what you're really looking at is an opportunity to leverage, without using leverage your purchasing power in equities. So if you're growth oriented, and again, you're stewarding wealth from one generation to the next, this is a construct that takes many decades to play out. But if you were just to trade a portfolio sort of once every 3 or 4 decades, you'd be talking about a major, significant increase in your financial footprint, whether that's in equities or in gold, being sensitive to that. So at a 1-to-1 ratio, you should be moving out of gold and you should be buying hand over fist the equities market. I don't know that we'll see 1-to-1 again. 3 to 1 is typically where you will see the market go on the basis of economics. And then there's got to be some other sort of layered concern in the market, geopolitical. That's what we had in the 80s when the Russians invaded Afghanistan. The concern was that they would march through Afghanistan, control the Middle East oil fields, and you had a mass rush into gold. We were at 3-to-1. We dropped to 1-to-1 very quickly. And then, of course, restart the cycle back again, favoring equities over gold in that period of 82 to the year 2000. So at 13-to-1, I'm looking at a very significant multiplier in terms of purchasing power in equities. I love equities. I own them. I just want to own a lot more of them. And gold will be a catalyst for owning a lot more as that ratio shrinks from 13 back to the global financial crisis levels of 6, ultimately to a 3-to-1. And maybe we get lucky enough to be at 1-to-1. I say lucky enough. I kind of hope we don't get there, because it means that there's something that has gone terribly wrong in the world of geopolitics. Maybe this time it's China and Taiwan. We'll have to see.
Well, that's great context on the Dow gold ratio. Thank you for that. Now, as far as gold miners, there's been a disconnect for quite a while between the price of gold and gold miners, although their shares that gap is sort of narrowing. And you've said that this year and next could be very good for the gold miners' share. So why do you say that? And is a big part of that the fact that they should be making they should be gushing cash and should have big margins?
And that is happening. So we had record free cash flow for many of your significant miners in the first quarter, and with even higher prices from the end of the first quarter till the mid-year, we've got another $300-400 more to the price. Not all of that will drop to the bottom line. You've got royalty payments, which are on the increase. You've got labor costs, which continue to be pressured higher. We have had a reprieve in terms of oil costs and energy costs, and that is a significant part of what either helps or hurts the miners' margins. But yes, we're seeing margin expansion. Yes, we're seeing an increase in free cash flow. And yes, we're looking at an asset class that is very, very underappreciated and underowned today. If you took a sample of U.S., Canadian, North American investors, very, very small percentage have even ever thought of owning that space. And I think that the performance differentials from the beginning of the year till now are very telling. Even in the first quarter, I thought it was very intriguing that we were in a risk-off environment coming into the April lows, April 8th, and yet gold was performing very well. And typically, gold shares will sell off in concert with the equity markets. That was not the case in March and April. In fact, they were outperforming on the upside. So that performance differentiation suggests that we have seen a turn in sentiment. We are seeing the Western investor come into that space in a real way, perhaps since the last major run, which ended in about 2011, 2012.
Okay, so broadly with the gold market, you've argued that this bull market really started around 2000 when gold was around, I believe it was 250 or 300 an ounce. So the first wave, the first phase was 2000 to 2011. And then after that, you saw some consolidation, but also the creation of a number of gold related products and ETFs and so on. And that you're also saying that phase 3, whenever it happens, is when the general public, the generalists get involved. But we haven't seen that yet. And we haven't seen any sort of mania like you alluded to in 79, 80. We haven't seen, the cover of magazines kind of thing where gold is all the rage. Why do you think that is? And that hasn't happened yet?
Mark, I think a part of it is there's other things for them to focus on. You've got the Mag 7, which have captured a lot of attention. You have the AI craze, which certainly has captured the imagination of the investing public. And so if you look at where the money has flowed, it's been to a lot of those names. Now, since April, very interestingly, a lot of the capital flowing into the equity markets has not been exclusive to the Mag 7. It's been to companies that have no revenue. It's been to meme stocks. It's been to cryptocurrencies and anything relating to crypto. And so you see the generalist investor speculating in a way that is frankly consistent with the end of a bull market cycle in equities, where you're really not paying attention to risk You're just playing for as much gain and as much reward as possible. That's also supported by the kinds of options trading that we've seen, that the dominant force of people trading options, where, options volume, again, if you look at over the last 6 months, we've set records, many weeks and many months in the last 6. We've never seen this kind of options market volatility or participation. 0 date expiration at being a perfect example. You're counting on a big move in stocks within the next 24 hours, and that's what you're betting on. That kind of a time frame, that kind of speculative dynamic, that's an end of cycle dynamic for equities, and that's not really something that we think is going to be fruitful for your longer term investor. Again, we go back to the Dow Gold ratio and say, all right, well, what could be a catalyst for seeing that ratio at 3 to 1? If we are in fact at the end of a bull cycle in equities, then we've already had gold move, and it can still move higher, but now that ratio gets a little bit more torque from a decline in stocks. So I think that the generalist investor comes into gold and comes into the gold mining shares when nothing else is working. They haven't paid any interest, haven't paid any attention, because they've had lots of other things that are working and have captured their mind space. I don't think that'll be the case as we move towards 2026, and we have yet to feel the impact, know what all the implications are of the tariffs and trade wars going forward. I'm not exactly sure what would be the catalyst. Sometimes we don't have a catalyst. Sometimes markets follow their own weight. And so if that's the case, I think you look at the performance differentials, you look at the amount of money that the miners are making. They're minting money. They're minting millions, in some cases billions of dollars, and that's gonna get noticed.
And just quickly with the equity cycle, when you talk about the bull market, do you see it as the peak in November 2001, and then that was the end of a bull market, and then it bottomed in, I guess, sometime in 23 or 22, and then a new one started, or is it all part of a larger bull market cycle?
Yeah, I mean, you can certainly make the case that, in the third, fourth quarter of 2021, when all assets were booming, we put in a top and are now playing with sort of a secondary top. But this is a topping process, a longer topping process in equities, and I would tend to believe that is the case. We're in a topping process. This is a bear market rally, if you will, and we've already seen some pockets of weakness that have yet to fully recover, and areas where, frankly, it's a bit shocking, the kinds of losses that have accrued. Commercial real estate comes to mind, but there's a tremendous amount of weakness with just 1 or 2 factors. If we see the higher for longer trend in interest rates, that is going to be an impairment to financial assets generally, and I think fixed income assets as well. There's so much leverage in the financial markets today. Moving interest rates up, even at the margins, at this point, will be highly consequential to the asset-backed securities market, the mortgage-backed securities market, and I think what we have seen, and what we did see in April, even of this year, is that the U.S. Treasury market looked and was behaving a lot like an emerging market in terms of its debt, and that, I think, if it appears again, will be very, very significant. So we're of the opinion that this is a topping process. The initial top was put in there fourth quarter of 2021, and there's a lot more downside than upside from these levels.
It's an interesting way to look at it, in that the animal spirits or the excesses of that bull market that peaked in 21, as you say, were never fully wrung out. And I think it's a valid argument. Now, a question for you here in terms of, as we get set to wrap up here, David. I know you do a regular podcast at McAlvany Financial Group, and you cover all sorts of esoteric and interesting topics. And I'm just wondering, is there anything top of mind for you that we haven't talked about that investors really should be paying attention to?
Well, I think that the volatility that we saw in the fixed income markets earlier this year is worth keeping in mind. We're at or near thresholds for the old bond vigilantes to come back. And it wouldn't surprise me that if in this period of time, instead of there being a migration of assets from equities to bonds, that there's more of a migration from equities into fixed income. And a part of this is that on a global basis, if we see pressure in interest rates, there's going to be sort of a lack of appetite for capital losses in fixed income. And I think the other factor there is we're just losing an appetite for U.S. dollar assets. And I'm thinking about this from a global perspective. There's a real hesitance to say, I want to partner and have my assets in U.S. dollars. Year to date, the dollar's down roughly 10%. So for a foreign investor coming into the U.S. markets, if you've got an 8% return in equities, you're still -2 in real terms by the time you do the currency translation back to your home currency. And we're in a period of time where you could see significant dollar decline. That 98 level on the U.S. dollar euro index is, I think, a significant one. If we don't significantly rally above that number and do it soon, I think you've already opened the door to a much lower dollar value, which again, I think puts stress and strain in the financial markets. And the normal migration, what you would predict, will be different this time. And I do think the metals are going to, and hard assets in general, whether that's oil, natural gas, variety of hard assets, will stand to benefit as you have some pockets of undervaluation relative to, a market today, which is just, it is, again, as we said earlier, price for perfection, price to sales of 30 times, price earnings. Again, if you're looking at, the cyclically adjusted price earnings ratio, it's in a 2.5, 3 standard deviation level, the kind of thing that, we haven't seen it as rich, but maybe 0.5% of, compared to all of the historical financial market timeframe. So I do think that the migration is going to be different, and the surprise is going to be how far gold and silver go in a context where treasuries are discounted as a safe haven asset. They're no longer the safe haven asset that they once were. Part of that's a dollar issue. Part of that's fiscal trust. Part of that's the way that we have weaponized the Treasury Department, weaponized the Commerce Department. And it does not sit well with our foreign trade partners. It does not sit well with central bank reserve managers who are looking for an alternative and have been doing so gradually, but I think they could pick up the pace. And so I don't want to put a number on it, but I think we'll all be surprised by how high both gold and silver go by the end of this cycle.
David, you covered a lot of ground and gave us a lot to think about it. We really appreciate your time today. Thanks for joining us.
Thank you, Mark. Anytime.
All right, to David McAlvany, the CEO of McAlvany Financial Group out of Durango, Colorado, and McAlvany Precious Metals. Our thanks to him. Thanks for watching. This will be up on YouTube in no time, in case you missed part of it. Thank you again, and we'll see you soon. Take care.